Hi, welcome. It's Mary Ellen McGonagle here with your weekly Edge show for Saturday, April 2nd. Today, as usual, we are going to take a look at the current markets and see where we closed the week. It was quite volatile. We had a rally into midweek, which fizzled into the close today on Friday. So we'll get into that as far as where the markets are positioned. All of this show is about helping you prepare for next week and even beyond. So also, we will take a look at some of the more impactful news last week that drove price action and how that can anticipate moves going forward into next week and beyond. And then viewer question of the week. And this week it's all about earnings. We actually had some very well-known companies report their earnings this week, and it's going to be in an effort to prepare you for Q1 earnings season that starts in 2 weeks. So let's not waste a minute and get started. Take a look at some of the news that drove the markets this week. And first up, consumer confidence, and it did rise for the first time this year. However, it was still backed up by inflation fears. More to the point is the fact that consumer and retail stocks really rallied. This was early in the week. Unfortunately, it did fizzle, as I mentioned, not just consumer stocks, but also the markets into the close for the week. We did get consumer spending numbers, and they did rise slightly in February. And this is telling us that the economy is still expanding as consumers continue to spend. A lot of that spending was leisure related, hotels and travel. Car sales, however, were down for the month of February. We did get a very important inflation number on Thursday with the core expenditure price index. This is a core inflation number that the Federal Reserve is paying very close attention to in order to modify their new monetary policy. And the number was month over month was down slightly. However, versus last year, the annual rate stands at 5.4%, so very elevated. The Federal Reserve is targeting a 2% inflation rate, so we are going to see higher interest rates. This is one of the reasons the markets were driven a little bit lower. Of course, the Ukraine-Russia conflict also fizzled in the way of peace talks did not take shape, and that was another reason that the markets declined into the close of the week. We did get numbers on Friday. The unemployment rate for March is close to pre-pandemic lows, and that's another indication that the economy is still growing. We did see wages increase quite a lot, and that unfortunately will translate into higher inflation as these wage pressures by these employers will need to be passed on to customers. So mixed at the end of the day, we are still seeing a growing economy, but that high inflation and the need for the Fed to continue to raise rates is really negating the positive economic news. So from here, let's go ahead. We want to take a look at the broader markets and see where did we close the week. And first up here, we are looking at a daily price chart of the S&P 500. And what I wanted to point out to you is that early week rally on hopes that the Russian-Ukraine conflict would recede. However, it did not, but also those high inflation numbers pulled the markets back. Good news, however, today we did get a rally into the close on Friday so that the S&P closed the week above its upward trending 10-day simple moving average. And then we also have a positive RSI and positive stochastics. These are both momentum indicators. You want them to be up above this 50 to indicate positive momentum, and we are seeing that. So that is good news. From here, we're going to take a look at the underlying sectors within the S&P. My work is all about uncovering where the strength is in the markets and then capitalizing on that strength. So here we are with a 2-month daily price chart view of the 11 sectors in the S&P 500. And I've gone ahead and added this relative strength indicator and sorted these sectors in descending order so that the stronger sectors are up here in this upper quartile. So let's take a look. Utilities, real estate and staples appear in the forefront. Each of these areas are not only defensive in the sense that they will fare well regardless of how the economy is doing, but also these stocks that are underlying in these sectors offer high yields, and high yielding stocks are a great way to hedge against the currently high inflation. So we also want to be aware of the weaker areas in the broader markets. And let's take a look. Financial stocks were down over 3%. That's relative to the S&P closing the week flat. And this is all about interest rates and what's taking place there. I'll go ahead and explain that further and also point out where the weak area is in financials. Again, so you're aware, you're not going to want to be particularly overweighted in that area. A couple of other highlights here for this week is healthcare. And this is an area that I pointed out last week as being in a very nice confirmed uptrend. And the group was up 1.3% on the week. So very nice outperformance relative to the broader markets. We will go ahead and I'll share with you where the strength is among these healthcare sector. So from here, let's go ahead and take a look at some other underlying industry groups in the broader markets to get a better sense of what's working and what's not. So I'll share with you as we move through these 2-month daily price charts, again, the strength up here in the forefront relative to your weaker areas. And first up is a look at the yield on the 10-year Treasury bond. And the relevance here is the fact that it's well above this 2% level. I'll pull up a weekly chart to give you precedence here, and we'd have to go back to pre-pandemic levels well before to get to that 2% yield. So certainly quite high. More importantly is the fact that this 10-year Treasury yield is currently lower than the short-term yields. And this is called an inverted yield curve. And it's not very good for bank stocks. I talked about financials trending down over 3% for the week. So I'm going to jump right into the banking ETF. Actually, we're looking at a daily chart here, and we can see the deterioration. Bank stocks down over 5%. And bank stocks fare much better when the longer term interest rates are high and shorter term interest rates are low because they make money on their lending activity using that spread. So that is one area that is expected to remain weak, certainly over the near term. I mentioned healthcare outperforming the broader markets in a nice confirmed uptrend. Let's take a look. These are the next two areas using the ETF selection that I like to look at, again, focusing on these higher growth areas of the market. And both of these groups are in healthcare. We can take a quick look here at what is called IHI, and that's a medical devices ETF, a nice continuation rally from last week. My MEM Edge report, we did put on one of the top performers in this group in the S&P 500 is, in fact, last week. And there are other areas of strength in there that I'm going to be talking about in my report this weekend as well. So you won't want to miss that. You can use the link below. But this medical device area is one area of strength within healthcare. And then biotech. This is another area that my report picked up. We did advise getting into IBB back here prior to this break, and a nice continuation rally, a nice outperformance this week with the biotech names as well. So nice to see that vibrancy in these somewhat growthier, IBB is riskier areas of the market, but there are sound reasons as it relates to the underlying stocks moving this area higher. Again, my MEM Edge report will dig into that to reveal further insights. But from here, as it relates to price action last week among underlying groups, good news to see that volatility is continuing to decline for the most part. We closed the week a little bit close to 20, still elevated. However, I like to see that volatility, better known as the fear index, below 18 to indicate market and investor sentiment that's a little more stable. From here, we can also take a look at a big underperformer last week, and that is semiconductor stocks. They were down quite a bit on the week, 4.4%. You can see this pullback, trying to close in a positive fashion. However, overall, we have a negative on that RSI momentum indicator, just now poised to see this MACD black line down through the red. And oftentimes that can be an indication of, at the very least, a pullback or a period of consolidation. These semiconductor stocks are impacted because Ukraine is the producer of a primary component for these chip manufacturers, and it is impacting the group negatively. So from here, let's go ahead and take a look. I mentioned that we would talk about a couple of names that reported earnings last week. And what I want to share with you with that is what is driving stocks to trade higher after reporting earnings so that you can be prepared as we move into earnings season later this month. So first up, let's take a look at Lululemon, LULU. The stock was a very big outperformer coming out of that pandemic, but really fell out of bed, certainly in line with other growth stocks, but even more than the broader markets. What I wanted to point out to you is this report here on earnings where the stock gapped up and pulled back only slightly while the broader markets pulled back further. And it is potentially finding support. Now, this is where I like to add, and I do have it here, a 5-day simple moving average. That is this blue line here. And you can see when the stock gets into an uptrend, it finds support at that 5-day simple moving average. Quite simply, it is a great way to gauge a buy point or an entry point because the stock is very clearly in a near-term uptrend, nice high volume characteristics. As it relates to earnings, the company came in 31% above estimate, but more importantly was management guiding earnings estimates higher for the remainder of the year. And I did a deep dive into about 20 big name stocks that reported this week, and that was a very common theme. Where management is guiding higher, that stock is going to trade higher. And here is another retailer that reported earnings last week, LOVE. I'll go ahead and pull up a weekly to share with you just what a big winner it was out of this bear market as individuals were mandated to stay at home. They were furnishing their homes. The stock had great growth prospects and did very well, and more recently sold off, and we can see a gap up very similar to Lululemon. However, I did want to share with you the fact that the company has fizzled. I'm not seeing much in the way of a potential continuation rally. They did come in 20% above estimates. However, management cited supply chain issues that will continue to plague them going into this year. So not that bullish increase to estimates that we saw with Lululemon. So let's go ahead and drill down to an intra-day chart with LOVE. And really what I want to share with you is what you can be on the lookout for if a company does have this tremendous gap up on earnings. You can see that it did, this is a 15-minute price chart, and it did originally rally following that first 15-minute uptrend. However, the rally attempt did fizzle. So what you want to be on the lookout for as it relates to these gaps up is if it begins to fade very quickly after that gap up. That's a clear-cut signal that this uptrend is in trouble. And then once the stock breaks below this 5 and 13 simple moving average, you can marry that with a downward trending RSI and certainly this MACD negative crossover, indicating potential further weakness, which has in fact taken place. So again, management's not guiding higher and then using that intraday to guide whether you should get into that stock or not. As a comparison, I'm going to share with you a 15-minute price chart of Lululemon, and here's that gap up on their strong earnings. And you can see really what you want to be on the lookout for is that third bar after that original gap up. You want it to trade above the high on that first bar. It did so, and we did see that continuation rally. At this time, the stock has very naturally pulled back after trading up over 20%. As far as a resumption of the uptrend, we do appear to be on the way as Lulu has broken above that 5 and 13 moving average. RSI is now positive. We'd like to see confirmation with this MACD trending upward and above that 50. That's it for this week. Those that haven't already, use that button below and you can trial my MEM Edge twice weekly report for a very nominal fee. And if you like what you've seen, you can hit that like button. Have a great weekend, everyone. I'll see you here next week. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.